The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Here we go. Good morning. This is Mitch Goldberg. You are listening to Money in the Morning with Mitch Goldberg. This is a live presentation on 103.9 LI News Radio. We greatly appreciate you being here. Let's get the week started. We look for a rebound today in the stock market after the drubbing it took last week, with the Dow futures indicated to be up 250 points. That's 0.76%. S&P futures up 35 points. That's up 0.9%. And NASDAQ futures indicated to be up 144 points. It's about 1.19%. Oil is just hovering where it's been for the last few weeks, $76, more or less in the middle of its trading range from low 70s to low 80s. We have a 10-year Treasury not yet reaching 4% at 3.92%. Yields are just off a little bit, which means bonds are catching a bid. So that means if bonds go up a little bit, yields go down. If bond prices go down, then the yields go up. So this means that there are buyers out there after assets, stocks, and bonds took a really big hit. Maybe interesting, maybe a bit dismayed that the Dow Jones Industrial Average is actually down 1% on the year. The S&P is still holding on to a gain of positive 3.4%. And the NASDAQ is still looking pretty good, up 8.8%. I mean, these are well off the year highs about 3 weeks ago, ever since we got that employment report, the non-farm payrolls, with 517,000 new jobs reported, jobs created. The first time unemployment numbers have been trending lower, below 200,000 first-time unemployment claims for 5 weeks now. That just indicates the strength of the labor market. And the inflation figures, CPI, that's Consumer Price Index, PPI, Producer Price Index, the PCE, all of the inflation figures have been coming in a little bit stronger than expected. You add it all up, it simply means that the Fed is probably not going to be cutting interest rates by the end of this year. We all still expect 2 more quarter-point hikes in the tank, but this is a big but. A lot of investors are starting to think that the next rate hike from the Fed will be a 0.5 point, not a quarter point. It does not mean that, oh, that's good, the Fed's getting its interest rate hikes out of the way. It means that the Fed is getting spooked, and it's getting spooked that it's not control. It doesn't have inflation under control. And one of the worst things for investors is uncertainty. And when you have a Fed that does not have control of a situation and it needs to act to get to control, to retake control, that's a pretty aggressive Federal Reserve in translation. More interest rate hikes, rates staying higher for longer, and it becomes a real challenge for stocks to go higher. Now, you could look at this in a number of ways. You could look at this as bad. You could look at this as opportunities will arise. Or you could just look at this and say, I'm just going to keep doing what I'm doing. If you have good financial habits, I'll maintain my emergency fund. I'll keep my savings for things that I know I have, pretty big financial obligations to spend on. You'll keep investing every pay period into your 401k plan, and you're not going to make sudden drastic changes because of a couple of months worth of economic statistics that people, are getting, who are traders, who are getting worked up over it over nothing that we're not going to remember any of this stuff. Remember, a lot of this stuff sounds good in the news. I'm not, oh my goodness, I'm not a media basher, guys. I'm just saying a lot of this stuff is interesting, but we've got to get you interested. We've got to keep you glued to the TV. So that's what you always hear people say, but we're not out of the woods yet. Or another expression that I can't stand, which makes anyone sound like Captain Obvious, is I expect the market to remain choppy. But we are going to have a choppy market. Look, the stock market has always been choppy since the day the damn thing was invented. And we are never fully out of the woods because there's always something on the horizon that could throw us off our game. And if you are one of the investors, the many who get thrown off your game, you are the one who's creating the opportunity for the long-term investors who buy when you panic, and they're the ones who do well. And with all of the information going around on the news, on the internet, I just don't really see humans being any better at trading than I have, and I don't see people better at investing. It's, human emotions are still there. And what I'm trying to do is counter that by giving you knowledge and sharing with you the benefit of experience. And I've been a financial advisor, by the way, for 33. This is my 33rd year in the biz. So I have some, standing legitimacy to talk to you about all of this lovely, good stuff. Okay. So the 2-year yield, okay, we're talking about interest rates now. The 2-year yield hit its highest level since 2007. And let's just, while I have you here, I'm going to just get the latest quotes on the bond market. The 6-month T-bill is still 5.1%. The 1-year 5.04%. The 2-year 4.789%. Let's just call it 4.8%. So, you're getting pretty decent yield to sit in safety. So the market has to give you something really special to pull you away from those yields. And if you're getting a 5% T-bill yield, if you have the T-bill in your IRA, on a tax-deferred basis, that's, for a lot of you, that could be like 8%. Okay, 7.5%. Some of you even higher than 8%. So that is a really good yield to take versus a choppy market, potentially higher interest rates for longer. So there's competition. We went from Tina, there is no alternative. You had to own stocks because bonds were paying nothing and the bank was paying you next to, nothing. And then we went to Tower. There are reasonable alternatives when interest rates started to perk up a little bit, when the Fed started raising rates. And now we're in the target market where, Tower was there are reasonable alternatives. Tina was there are no alternatives. Target is there are really good alternatives. And I find that investors are very attracted to the 5% yields they're getting for 6 months and a year. So, and I don't blame them, based on everything, that I've just said. Hopefully you don't blame them either. Long term, I still believe in the stock market, of course, because I think that's where you get your best gains long term. But for the short term, money you'll need over the next year or two, there are plenty of places to hide out. And for those who are going after high dividends because there was no other game in town, you see those stocks, dividend-paying stocks, are down a lot also. How dividend-paying stocks started to be thought of as, stable, unlike stocks, and they were thought of more as bonds, it's one of the sadder things that happened with interest rates near 0% for so long over the last 10 plus years. But we digress. We need to focus on what does all this mean for you? Interesting note, Union Pacific. That's the railroad that, their CEO is Lance Fritz. Union Pacific is the railroad that had the spill in East Palestine, Pennsylvania. I don't know if you pronounce it East Palestine or East Palestine, but he is stepping down. The stock is pretty much back up to where it was on the day that the oil spill happened. Like it or not, we still have very few railroad companies to choose from, and like it or not, if you're going to be in a railroad, you don't have much of a choice of where to put the money. So that stock is already recovered. In any event, you're listening to Money in the Morning with Mitch Goldberg on LI News Radio 103.9. This is a live presentation. So stick around. We've got some really good stuff coming up right after these very brief messages. Thank you. Okay, we're back. We've got a lot to cover today, and I wish we had more time together. But let's squeeze in everything we can and make sense of it. We left off that Union Pacific CEO Lance Fritz will be stepping down. The derailment in East Palestine, Pennsylvania, was February 3rd. The stock right now is up almost 10% in pre-market. News that the CEO is leaving. Other moves, CGen, which used to be called Seattle Genetics, is up almost 15%. Wall Street Journal reports that Pfizer is in very serious talks to acquire the cancer drug maker. Best Buy had a little bit of a slip after a downgrade from Telsey Advisory Group, but that stock's been up a lot. Berkshire Hathaway had their they released, Warren Buffett put out his incredible, fascinating annual report, which I'm going to be reading over the next couple of days. I can't wait to sink my teeth into that. That's going to be really good. And that's about it. Also today, durable goods figures came out today, and they were weaker. They were weaker than expected. They were pretty piss poor, actually. Just, durable goods are goods that last 3 years or more. So dishwashers, washing machines, appliances. There was some funkiness going on. Transportation goods has a big part of that. So if Boeing gets a big order, that affects greatly transportation goods and manufactured goods. But with everything all considered, manufacturing is showing some signs of weakness as of the latest figures. I don't know if that's exactly what the Fed needs to say. Oh, we're pulling back on our interest rate increases. We really need to see what the labor market does. The next labor reading is going to be March 10th. So we have about 11 more days. So not this coming Friday, but the following Friday is what we really have to wait for the market to find direction. That's really what it comes down to. It's just we have to see what the next labor report is. Every month, the Department of Labor puts out their unemployment report, jobs created, things like that, and we need to just wait. Tomorrow, consumer confidence comes out, and the ISM Institute of Supply Managers, say that 10 times faster, for manufacturing comes out on Wednesday, and Costco reports earnings on Thursday, and that will be watched very closely to see the state of the consumer. All right, so let's take a look at what to do here. This is all interesting, important news. I find that the news could help me make better decisions. I'm also a news junkie, so to me, this is really interesting, fascinating stuff. But what you do with this has a lot to do with your future success. And when I say success, I mean, are you going to be a successful retiree? There's a lot of people who are very successful career-wise who do not become successful retirees. And there are a lot of people who don't make big money who actually become very successful retirees. And it comes down to, it's not what you make, it's what you keep, it's what you grow, and it's what you have to replace your income when you finally decide to retire. And excuse me, sorry, you're still putting up with my nasalness all winter long, but when I meet with people, I often see that the expectations are so unrealistic of not only when can they retire, but the lifestyle that they want to live in. And sometimes the solution is you're just going to have to work longer if you are able. And I see with a lot of married couples that, if one spouse is having health issues, the other spouse often can't work because they're driving their health impaired spouse to doctor's appointments all the time. And I see this a lot, especially as people get older. You would be amazed. I have clients who are seniors. They often spend a great deal of time running from doctor's office to doctor's office. That becomes how they spend their time in retirement, a lot of them. So we've got work to do for you. But I'm not trying to be negative. I could just tell some people I depress the heck out of. But I want to give you hope. There are people who can turn things around, and there are plenty of people I meet with who are completely ready to retire. Sometimes they come to me in that state. Sometimes I help them, if they come to me earlier in life, I help them get ready. And it's a real eye-opener. But even clients who are not ready for retirement, who are far off, I could still help them get ready as long as they're willing to take the actions. And sometimes the actions are drastic, and it's a real impairment to their lifestyle. And there are a lot of people who will not be drastic because they are afraid of how they're going to look to their peers, their friends, their family. Some people are just caught up. That's what I mean by some people are very successful in their earnings years, but they're not keeping it. They're not saving it. They're not investing it. They're saying, I'll do it next year. I'll get to it next year. I've got more good years left. The time goes by fast. All right. So let's talk about something that a lot of people, with the few minutes we have left, let's get into something that people get wrong very often, and that is diversification. So two things I'll say. You cannot invest directly into an index. We always talk about the S&P 500 as an example, but you could invest into a security that tracks or mimics an index. The other thing I'll say is diversification. It's a strategy that we use to diversify risk, but it doesn't necessarily prevent your portfolio from going down in a generally down market. There are 11 sectors in the market. There's real estate, there's industrials, there's consumer staples. I talk about this a lot. But right now, what you're seeing is indecision in what to buy. Should you buy companies that are defensive in nature? I don't mean defense contractors. I mean companies that are defensive, that are more or less practically recession-proof, like drug companies that make consumer staples, toilet paper, toothpaste, the things that you have to buy no matter what the economy does. And then there's industrial and discretionary, stuff that you really avoid buying, that you don't want to spend money on when the economy, could be getting weak. And you need to have, in my opinion, a mix of these sectors. People get too caught up in one sector, like they're all in technology and tech-related stocks. Then they're all invested in all energy stocks. And it's because investors are trying to juice their returns extra. They're taking more risk because they're trying to make up for missing out on market returns through the years. They're trying to play catch up. And what I see, I have decades of experience. It might work for a little while, but then it actually it sets you back even further. So when you look at individual stocks or sector funds, I always like to say, make sure you have at least 3 of each side. On one side, you have economically sensitive. On the other side, you have economically, what I would say, insensitive. You need to have both kinds of stocks or sectors on each side of the ledger. And if you can't figure that out, there are many other products that will give you the best of both worlds. And if you need help, obviously, I hope you have a financial advisor who you like and trust. If you want to take this conversation further and have a one-on-one with me, you can check out moneyinthemorning.info. That's where you'll find out a little bit more about me. My contact information is there. And you're welcome to reach out to me for a one-on-one, and we'll see if we're a good fit. Sometimes people just have a quick question and we're off the phone. Sometimes I want to talk to you, and I'll keep you in the back of my mind if I need you later on. And that's all fine. I'm happy to speak with all of you. Thank you. So this is Money in the Morning with Mitch Goldberg. Our time is up already. It goes by way too fast. I'll see you tomorrow. I can't wait. You're listening to a live presentation on 103.9 FM, LI News Radio. Stay tuned for more homegrown programming. Here we go. Thank you.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views and